Hello, everyone. You are here for Welcome to Straight Talk, behind the scenes of corporate debt restructuring in emerging markets. Our speakers today are Richard Marney. He is a senior risk advisor at responsAbility, and he is joining us from Malaysia. We've got Tim Stubbs here, a partner at Dentons, and he's joining us from Russia. And we have Oleg Ivaniychuk. He is the head of restructuring at responsAbility, and he is joining us from Switzerland. A little bit before we start, while people are logging in, we are responsAbility, a sustainable investment house that specializes in impact investing in emerging markets. And we are hosting this webinar today because our dear colleagues have just published a book of their war stories about restructuring. And it seems that it is a tremendous learning tool for the field and I think for life. So with that, I will dive right in. I recognize that the three of you have a long working history together. So first of all, I'd like to know, why and how did you all get involved in this field and into working together? Let's start with you, Richard.
My first assignment after my training program in banking in the late 1970s was to go to Latin America. And I guess I must have brought the decade of financial crises there. And then I moved from there to Asia, where they also went through crises. And then eventually I came to Switzerland, where I had the good fortune to meet Tim in a restructuring engagement, and also my good friend and colleague Oleg doing the same. So I've been at it for a few years, and I've been a goodly part of that with my two colleagues. Thank you.
And you, Tim?
Yeah, well, I'm going to date myself, but not quite as far back as Richard did. In 1987, when Black Monday occurred, I looked at the partner in my law firm in horror, and I asked, "What do we do now, Paul?" And he said, "Bankruptcy, Tim." And it was a lesson that markets go up and down. And I practiced law in the United States for 6 years before coming over here. And during that period, there were market corrections, and in the good times, you do the deals, and in the bad times, you restructure them. And it came over to Russia in 1991. And since then, we've had a number of crises in this area of the world. And every time there's some level of restructuring that goes on, more often in this part of the world on a workout basis than in the insolvency courts. And that led to taking closer looks at this area when the crises occurred. And in the last decade, I've started to work quite a bit with Richard and Oleg in various emerging markets restructurings.
Great. And Oleg?
Yeah, I mean, actually, I will need to bring you with the history from 20th to the 21st century, because it was 1970s or 80s. Actually, it was 7 years ago when I was a joint responsibility. I was supposed to be a regional credit risk manager for the Eastern Europe and former Soviet Union. But a few months after I joined the company, the portfolio started going into trouble. There was commodity price crisis and also sanctions to Russia. And instead of providing new loans, I had to start suddenly moderating lenders groups. And so actually was a little bit coming like virgin to the child. You're supposed to be credit risk manager, and then you go directly into the restructuring. Yeah.
All right. So to kick off here, let's also see where our audience is at with restructuring. So I'll launch a poll. And while they are answering that question, why is restructuring important to emerging markets asset managers? Oleg, I'd like to have you tell us, what is restructuring? Give us a few tangible examples and maybe some challenges.
Yeah, I mean, we can say if we speak about restructuring, you might think that this is like, I don't know, mafia people who press somebody to pay loan, hard collection, street fighters, gangs, but actually people who are using Kalashnikov, yeah, to enforce. But actually we are doing the opposite of that. We come into the situation where there's a lot of uncertainty and urgency and very often panic. And we have to work on reducing uncertainty, complexity of the situation, bring people together in order to find solution. So our job is actually more like engineers for building the bridges and for working together with all stakeholders on the solution where most of stakeholders will be better off if they cooperate and not only focus on the individual interest. So this is actually what we are doing. And interesting also that restructuring is also people like we, there is even no one terminology for that because sometimes called corporate recovery, restructuring, special operations, special assets management. Yeah.
Great. So you can see the answers to the poll there. Any comments from the three of you on how people responded or the answers in general?
I would highlight the third, which is contribute to the stability in the market. That's often what people don't think about, but it's actually extremely important. And I think we've seen, as we'll discuss later in this hour, cases where the benefit of a successful, to use Oleg's apt term, an engineering exercise is not just to safeguard capital and the continued operation of a borrower, but also to keep the market on a straight and stable course.
Great. So let's move on then to the book, Richard. So Oleg just described the complex endeavor that is restructuring. And so what does this book about restructuring then strive to accomplish?
Well, we were thinking about talking about automatic rifles, but we didn't think that would be correct. So no, perhaps, and I'll start, but invite my colleague Tim to continue. First, the question of why we wrote the book, and then why we think the book is of relevance. The idea actually came to us in the summer of 2019, 6 months in advance of COVID. As Oleg and Tim recognize, there was the end of a long credit cycle, and with increased leverage at both the sovereign and the institutional levels, we were growing concerned that if interest rates normalized and or the economy slowed down, that we could see a pickup in stresses on companies and therefore the need for more engineering jobs, restructurings. And that was in the context of recognizing from our experience in 2014-15 that when there's a spike in restructurings, many houses simply don't have the staff to deal with the volume of transactions. Tim?
Yeah, that's right. And most of the emerging markets jurisdictions will not have the right, let's say, legislative and judicial infrastructure to be able to handle distress situations the way more developed economies like the US, Western Europe, or the UK have. And as a result of that, it really places an emphasis on a consensual approach to restructuring. You'll get far greater returns in a consensual restructuring than you will going into the courts in an insolvency. Even if the local insolvency rules might have judicial restructurings, ordinarily there are a number of problems with those rules and the way they work. Either they're not advanced enough to replicate Chapter 11 style proceedings, or people don't rely on the courts because of a mistrust, or it may be an uneven playing field where the courts have a lot of problems with transparency, corruption, or it may just be that the courts, once you enter them, it's a morass where you're in there for years and years, and as a result of that, the borrower's business dies. And so as a result of all of this, there's a huge premium on doing workouts when you can do those. And in order to do those, you have to have a methodology for approaching them. And that's what Richard and I decided to put in front of the readers.
Great. So you mentioned the methodology. Go ahead, Richard. Did you want to add to that?
No, I just as a very quick postscript, Stacy, apologize.
Yeah.
I think that what everyone who's on the call, whether they're negotiating a loan or an M&A trade or a restructuring, recognize ultimately comes down to people and process. Our view is that because of the nature of restructurings, those skills are even in more acute demand, and therefore the approach of the book was not to address the technical aspects of debtor in possession financing or collective action clauses, but try to communicate to the reader the experience in the negotiating room, and therefore an understanding of the overall process of workouts.
Perfect, perfect. So you really want to give readers a tool, and so I think what you did then here is this 5 stages of restructuring, and this methodology. So Tim, could you maybe get into that a bit for the audience?
Yeah, well, it was credit to Richard in terms of when you have a huge problem in front of you, you just don't know where to start. And so Richard suggested, and we followed this, is a framework for the structure of the book, that we break this, the restructuring, the life of a restructuring transaction into 5 separate stages. And we look at each stage critically as to what the requisite skills are in that particular case, and what the lessons learned are from those cases and from those stages. And on top of this, we felt that it was important for readers to see narratives and case studies, not only dry kind of Harvard textbook type case studies, but our first case study is a narrative. It's about 60 pages long, where it follows a cast of characters through a whole restructuring transaction. And so we've taken this, the restructuring transaction, broken it down into phases. The first phase is pre-restructuring, which effectively commences with the disbursement of the funds during the entire credit monitoring stage, what the restructuring officer has to be doing in order to prevent problems from occurring. The second stage being the decision-making stage, where the parties finally realize that there is a problem and they have to come up with a solution. And this concerns, well, raising the issue with the other lenders, raising the issue with the borrower, getting the sense that everyone has agreement that something has to be done. And then there's the case setup stage, where the parties do get around the table and look at what needs to be done, and there's a lot of process involved here. Then the structuring and implementation stage, where the parties actually put together the framework for the solution that they'll have, whether there's going to be a business or a balance sheet restructuring or a bit of both, whether they're going to be debt to equity swaps, recaps, changes in the covenants, the kind of things that will help to alleviate the pressure on the borrower's business in order to allow it to recover. And then on top of that, there's the final 5th stage, which is the implementation stage, where people actually sit down, draft the documentation, put the CPs together, and the frame for actually how you implement the restructuring. So those are the 5 phases.
And Oleg and Richard, do you want to comment on the 5 phases at all? Any specific?
I mean, I would say that what I like very much about this phase is this is a preventive stage, because it's, restructuring, it's a little bit like being financial doctor. Yeah, you can address the problem where it's already acute, it's big problem, or if you're timely involved, you can prevent a lot of damage. And I think it was what Tim was describing, I think last year was really without precedence in the history. Because of COVID, most of the lenders were reluctant to roll over their loans. And if everybody would just retreat from rolling over, many banks and microfinance institutions would have simply collapsed, for liquidity reasons. And it was great spirit in the industry to bring all the major stakeholders together and to agree that we roll over and provide liquidity, prevent liquidity crunch based on one-pager, non-legally binding document, because we didn't have time even to go for the proper legal documentation. And it was amazing. It was very difficult, intensive, but it was amazing when you have 10, 20 creditors and people based on the email agreement on one-pager go ahead and prevent big problem, give companies the time. For me, it was really very impressive recent development in the industry. Yeah. So.
So agility is the real recent development, I would say. So Richard and Tim, what are other significant lessons that you've learned from your years working on restructuring cases?
Well, before I go into the full answer, I'd like to highlight a very important part of Oleg's comment, or what perhaps lies underneath it, which is the decision to proceed the way they did took into consideration the actual practical necessities of the situation. The rule book was thrown out the window and they did what was necessary for that time. So that agility, flexibility, creativity are important characteristics in many fields of work, of course, but significantly here in restructuring. I'll start with the longer answer. If we walk through the 5 phases, I think for the first phase, as Tim said, it's smart structuring, recognize pitfalls in the borrower and the market that can be mitigated even before you disperse the money. And then secondly, monitoring is a proactive anticipation of potential problems. When we have gone back in both deals on which we've worked and others and tried to diagnose what went wrong, in probably somewhere in the range of half of them were just poor credit structuring and poor monitoring, not market crashing and the like. In the second phase, which is the decision to restructure, in the book, we use the overused image of a boiling frog. Sometimes people just get lulled into a sense that next week things will get better. They sometimes don't take decisions because of damage to themselves and the company, or a relationship that they don't want to hurt. And so that's an important lesson: is don't overestimate relationship damage, because as a doctor, as Oleg said, sometimes you have to deliver difficult news. Phase 3, and then I'll hand it over to Tim, is all of us have seen many transactions get off on the wrong foot because of bad planning for that first set of contacts. So there needs to be a script in advance, what each side will do, won't do, limit any kind of emotional damage. The role of personalities matters enormously, as we show in the narrative. As in any business relationship. And lastly, be realistic. Don't try to revive the dead. If there is a way forward on a going concern basis, do that. But don't waste time when there isn't really a salvation there. Tim, over to you for phases 4 and 5.
Yeah, and in phase 4, in the structuring and implementation, you really have to do a cost-benefit analysis of the solutions that will work and will not work. And the first question that the restructuring officer and their counsel are faced with: what do we do now? What's best in this particular solution? That's going to depend upon a careful analysis of the insult principles, whether they can be applied in the given case, whether or not the judicial mechanisms in a particular emerging market and the legislative framework, including the insolvency law and the way that's implemented in the courts, those things have to have a careful look taken at them. There may be other things that are very important, such as depletion of assets and wrongdoing that might have taken place either by the management or by controlling shareholders or shadow directors, things that need to be unwound or invalidated in the case of interested party transactions. And so you have to take a careful look at whether or not, in this particular case, a judicial solution or a consensual solution is going to work best. Certainly either of those will, beyond a doubt, be better than a liquidation, which in most emerging markets is going to result in pennies on the dollar as opposed to dimes or quarters. So this set of questions has to be looked at during the structuring phase, and then the parties have to decide what they want to do. And as we say, it ain't over till it's over, to quote Yogi Berra. There can be so many surprises along the way in terms of unexpected changes of heart, or things where people decide to play a little brinkmanship and say, I'm not going to go along with the deal. So all of these things, or macroeconomic events, or the regulator decides in the meanwhile to take over a licensed institution. All of these things could happen, and so you have to be flexible. Most importantly is to be flexible during this stage. And then finally, in the implementation stage, it's really a question of ensuring that that you have full follow through to get done what you intend to do, and then to have the boots on the ground to make sure that there are solid advisors actually sitting for eyes and ears of the lenders, sitting in the borrower's offices to make sure that things go the way everybody agreed that they would go.
Yeah. And Stacey, if I can jump in, and I'd like to go back to a comment that Oleg made, because I think if there's one major takeaway from all of this, it would be the following. Oleg referred to being a doctor, and I think the example of what he and his colleagues did so well during the initiation of the COVID era is a testimony to this. The overall aim of restructuring is to keep the patient alive. And when we went back and looked at the cases that we use for our kind of our database from which we created our mosaic narrative over the 4 decades, we found that roughly 3/4 of the transactions saw the company survive. Half of them were refis or recaps, another quarter is where they were sold or merged with somebody, and only a small number, around 15%, actually went into wind down or restructuring. And so when all of the restructuring professionals that are participating in this webinar think about the work that they do, I'm sure that they agree that the overriding objective is to try to get the company in whatever form back doing what it does for the good of the economy.
Absolutely. So let's move on to Oleg here on today. What are you confronting today that sort of demonstrates the lessons that Richard and Tim have been talking about right now?
Yeah, I think it is particularly it's good that we have Tim as a lawyer here, because a book is focusing on the emerging markets, and I think the big difference is, which has big implications for any restructuring work, the quality of regulation is not always very high. There is room for upgrade. And also the legal systems are very often court legislation are in the developing stage. And very often, whatever is in the legislation is not lived, not executed properly. Yeah. And this brings us to the also we are very often not sufficiently protected by regulatory and legal framework in our work. That's why how you can you compensate for that? You can compensate for that only through building very strong relationship with the stakeholders. Yeah, because you cannot say court will decide, because court hearing might happen in 2-3 years, and we have also cases where we have this entertainment. And this is, I think, we're coming here to the human skills. You need to certain aspect to replace this legal regulatory framework through relationship framework. You need to build us trust, communication, because at the beginning, as I said, we provide solutions, but you cannot provide solutions if people don't trust each other and don't talk to each other. And it is particularly prominent because very often we have very difficult conversations. There is tension, there's disagreement, so-called fights. And it's always important not to lose the focus, yeah, and to understand that tension is okay, conflict is okay, but we are not allowed to cut the communication line. Yeah, we need to continue talking to each other. It's not always easy, because sometimes people just leave the conference call, just throw the telephone and start screaming. But yeah, we need to be patient to go through that.
Like you never do that, of course, right?
No, me not. I had the pleasure to be a recipient of such behavior.
And Oleg, what do you do when someone does that? I'm curious.
I mean, it's a good question because I had really a situation where we had tried to rescue one bank, and during one of the calls, one of the lenders thought, "Look, I have enough. It's useless," and just left conference call, and this lender was blocking everything. And then the next, I managed to talk to him bilaterally to bring back to the desk. And the next day we had conversation, but it was also a little bit not very constructive. People were reiterating their frustration. And then another lender freaked out and thought I have enough from that. Then I needed to talk to him. And somehow it's so obvious. People let's talk to each other, but it sounds so basic, so innocent. But it's not always easy. If people start hating each other, getting emotional, and I think you need to be emotional because if you're patient, in order to be good in restructuring, you have to be patient. And if you're patient, you can be also emotional. But the art is really to reach the level where you're patient, but not too much emotional. You're patient and still balanced. Yeah, I think it is. Yeah, you need to calm down the people. But you need to talk to people. Nobody is allowed to lose their face. It's also very important because even if somebody is leaving the table of negotiations, like on the webinar or physically, it will not work. You need to bring people back. Yeah. So talking, convincing, being patient, listening helps a lot. Yeah. What sounds, of course, very innocent, nice task. Yeah.
I think it helps in everything, but this also leads well into our next question for Tim, which is why will the future intensify the need for this very special skill set that Oleg was talking about?
Well, during the COVID, the governments had given a lot of relief in terms of moratoria on insolvencies or tax relief or other forms of relief to employers. And as a result of that, that's kind of delayed the real impact of COVID on borrowers. Lenders have extended and pretended, closing their eyes to covenant defaults and things which ordinarily indicate serious financial problems. And as a result of this kind of collective kicking the can down the road, the debt has grown. Macroeconomic trends tend to indicate that there may very well be a serious market correction and recession in coming years. No one knows. Richard and Oleg are the economists who can tell you when that'll happen. I don't have a crystal ball, but I believe, based upon what I see on the market, that we are in for some rough seas. And it's far better to be prepared for these problems than it is to just deal with them when they occur. And the lender clients that I've spoken with have admitted that there are serious staffing problems within their institutions in terms of dealing with a large wave of restructuring. And so obviously we don't have cloning yet where the heads of restructuring can clone themselves to have an army to deal with these problems. And that raises the question, how do they train their teams? How do they train people who may have come in from the origination team or other teams, or how do they get these people up to speed to be able to deal with problems which they individually may be able to deal with? And so Richard and I wanted to put a learning tool, an educational tool into their hands so that they could at least say, here's something that Richard Marney and Tim Stubbs wrote. It's pretty good. I don't necessarily agree with everything in it, but it really covers a lot of issues that I think will help to give you an idea of what we do on my team. And sit down and read it, and let's talk about that, and then go forward from there. So that was the idea behind the book.
Great. And Richard and Oleg, is there anything you would like to share with us from your crystal ball of the future, since Tim brought it up?
Well, I think crystal ball exercises are always dangerous. If you get them wrong, people remind you of them. And if you get them right, they say you were just guessing. Look, I mean, there's a lot of ways that economists and other experts are trying to answer the question, is there a wave coming? Some has been an insolvency gap. Others have just tried to do it at a micro level, going up in terms of debt service coverage ratios and all the rest of it. I think we need to be prepared, even if there isn't a wave of restructurings that overwhelm the sector, because the combination of COVID's impact, eventually there will be monetary and fiscal policy normalization, which will reduce that part of the impulse to growth. Interest rates will create stresses for a number of countries and borrowers. The news of the last week, you can guess whether Evergrande will be resolved quickly and what the fallout will be, whether or not Washington can raise the debt ceiling, all those things. So predicting, I've never been good at it, so I won't try now. I think being prepared for an increased incidence of, to go back to Oleg's very good point of engineering jobs is worthwhile for institutions that manage risk for a living. Thank you.
Yep.
Yeah,
Oleg?
I absolutely agree with that, because of course we don't have crystal ball, and if you would make statement that we have crystal ball, I mean, you can also blame us that we are doing something, saying something which is not true, because I mean, look, challenges
Which
will
you
come.
never do.
And, yeah, exactly, and this is important. We don't pretend something. We work, we realize complexity. I think we prevented all stakeholders in the same liquidity crunch. There will be pressure on capital position because losses will be accumulating. Some companies will be hit more, some less. To what extent they will be hit, it needs to be seen, because it's also, if you need to run all the losses through a P&L during 1 year, it can kill the bank. But if you have regulatory leeway for 2-3 years, it might provide some breathing space. Shareholders might support. I think what is important, we cannot say, there will be risks, let's stop everything, because it doesn't help anybody. We need to be prepared. We need to be prepared if something is coming, that we are not surprised, that we proceed in a structured approach through the companies, between the organization. That is the best thing we can do. Of course, many emerging markets are driven by commodity prices. We need to monitor them, but it is also does not explain everything. Yeah. So I think just proper risk management for me means also you take the risk on the book, but you monitor them, you analyze them, and if something goes wrong, you handle that. It's not just avoiding the risks. And I think, we need to be prepared and work intensively on that. And we have already some experience. So.
All right, great. Well, I'm going to launch another poll to see where our audience is at after listening to you guys for a little while. So the poll is, after listening to our experts here, what is the most important skill to have in restructuring? And while people are weighing in, as we promised some war stories today, I would like the three of you to give us your best war story to give listeners a real flavor of the emotional intelligence necessary that you need to use behind closed doors. So Richard, let's start with you.
Sure, I'm going to do two quick ones. One, a corporate credit, and the second, a bank credit, which highlight different elements. And in giving or relating the story, we'll, as my colleagues will, we'll do it using the 5-phase structure that we outline in the book. The first is a diversified telecom and media company that the moral of their story was that they banked on the internet a little bit too early. In phase one, the origin of the transaction was a number of traditional house lenders accepted the telecom companies, in retrospect, overly ambitious business plan to build a kind of a countrywide fiber optic network to support a very rich media content internet product early on, when connectivity was not great, and people's buying patterns weren't quite internet focused yet. Fairly early on, the uptake of the services beyond the very basic subscription lagged, and the company had taken a very highly leveraged approach to funding the business. And over time, the lack of operating cash flow and the cost of the debt began to swamp the rest of the group's profitable businesses. The shareholders balked at recapping. The lenders offered a series of solutions, but they were really ignored until the message came: we're gonna call a default next week if you don't sit down and talk to us. As Oleg and Tim and those on the phone have often encountered, the initial offer from the shareholders was, well, lenders, you fix it. And they wanted a debt to equity conversion or debt forgiveness and new money and everything else you can expect. It was turned down. Eventually, the parties agreed that the option was default, call a default on Monday, or agree to the plan Sunday night. And so what happened was a standstill was put in place. Unlike the handshake of which Oleg spoke, it was a legal standstill, as Tim can describe. And then we used that period to discuss amongst all the parties what we were going to do. And in the end, the solution was to sell the internet business so that the company could maintain its mobile cellular and international gateway type business, and then attempt to provide enough capital for the rest of the legacy business to operate. That took several months of many times people doing what Oleg said, is hanging up on the phone and walking out and throwing books across the conference room. Eventually, the sale was successful, although at the last minute it was required that the lenders provide some fairly robust acquisition financing, and the transaction was finished. What is important is to really cite, or firstly, the lenders made a big mistake in the beginning. It was clear that the business plan in retrospect would never have worked. Secondly, they delayed telling the emperor that he had no close. The restructuring negotiations were quite difficult because people were standing to lose a lot of money. And then lastly, the execution was challenging because of all the various parties, and it ended up taking 6 months, during which time the legacy lenders had to continue to not call default even after the standstill was eliminated, and provide fairly robust financing. So that was a corporate name. A second one, and this is one in which Tim and I worked, is in the midst of an FX and banking crisis. A bank encountered serious asset quality deterioration to the point where, if provisioning was done correctly, the company would be insolvent as per the local regulatory minimum standard for Tier 1 and Tier 2 capital. The shareholders were unwilling to recap it, and it was clear that by the next quarterly reporting date to the local supervisor, that it would be in breach and be likely liquidated because it was a deposit-taking institution. The shareholders, as is typically the case, countered with, banks, you fix it. The banks talked about it, but in the end said no. And eventually, there had to be an ultimatum. Again, here you are, taking the risks that the thing could go into liquidation in the courts, which would have been a disaster. And the solution was really quite simple: selling the institution to someone who could recap it. And so within a fairly brief period of time, a sales process was engineered, successfully completed. And as we got close to the end, certain lenders wanted a sweeter deal, so that had to be accommodated. And then I think we closed with a little bit of time to spare. I think here again, the lessons are, the institution was very sound, frankly well run, until it was swamped by macro developments over which it had no real control. However, the immediate solution was not balanced between the lenders and the borrower, and in the end, the only viable solution was to sell the institution, which again, going back to the medical analogy, is I guess you could say we put them into intensive care for a few days, but then in the end, the patient was healthy and survived. So those are two cases: one corporate, one bank, one idiosyncratic mistakes, the other was a more of a macro or market-driven crisis.
Tim, Oleg, you want to add?
Okay, well, I'm not going to go into quite as much detail, but I've had several cases here in the former Soviet Union of restructurings where it was clear that there had been intentional wrongdoing by management and shareholders, and nonetheless, the bondholders in those cases, these were not loans; they were bond issuances. The bond issuers were nonetheless willing to engage in consensual restructurings, or at least to try to pursue those. And as time went on, it became very clear that the incumbent management just were not going to change the way they deal with things. And the bondholders ended up losing out everything in both cases. And so that's a case where sometimes you do have to go into insolvency and you do have to seek redress in the courts, and intentionally avoiding the courts will sometimes result in bigger losses than actually taking advantage of the courts. So you can't just say a workout will always be the best solution in every case. And if you have foxes in charge of the chicken coop, don't keep the foxes in charge of the chicken coop, because there are not going to be any chickens left at the end of the day. So that was one of the lessons from one of the several of the deals that I've done, that you have to have integrity and honesty on the other side of the table. And if you don't have that, then it's a non-starter to begin with. The second was in terms of the bank restructuring that Richard had mentioned. It was one of the first, I think it was the first consensual bank restructuring in this particular country in the Caucasus. And it showed that when you have a regulated financial institution, it's critical to keep the regulator abreast of your discussions and to involve them constructively in those discussions. And I think it was Oleg who went into that office time and again with our lawyers on the ground to make sure that they understand what the lenders are doing. This is the plan. What do you think of it? Do you have any comments on it? And we were actively working with them to create a stake by the regulator in the plan so that they understood it and went forward with it. And if we had not had that level of really active participation of the regulator, then quite possibly they may have just stepped in and taken the bank over. I don't know if you want to add anything to that, Oleg.
Absolutely. I think it is like, and what you're saying, honesty and integrity, sometimes you are forced into the situation where somebody is forcing you to commit to certain deadline, to date, when magic will happen. For example, you go for the debt to equity conversion. And if you have some experience, you understand that you are not in a position to provide the date. So you have to deliver something, but you cannot commit to something which doesn't work, because even today you don't know how long it will take. It will be, that for sure 3 months is not enough, but it will be 6 or 9 months or 12 months, you don't know. This is very important to engage into the dialogue, because we had a situation when we had financial advisor, we ran the numbers, we could save the bank. And coming back to the beginning of the call, what is important, and what Richard was saying, it's far beyond recovering capital. I mean, if you have leading micro lending bank in the country with 1,000 employees, on one side you recover money, but this is also 1,000 jobs. It is also flagship bank in the country, which is by far the leader, and you're working on rescuing this bank. And then actually it was interesting. Regulator was pressing corporate governance of the bank for the date and for the volume of recapitalization. We went for the meeting with the regulator. We say, look, we can rescue this bank. It works. And I was told, you need to tell regulator 2 things, otherwise they will not take you seriously. You need to tell them the date when you rescue and the volume. And I thought date doesn't work because we don't have the date. Volume I can disclose because we had already analysis. But instead of committing to something which we cannot, we explained the situation, and we had also to ask the regulator, we can rescue this bank, but do you want this bank to be rescued? Because we don't want to do it against your will. Answer was yes. And instead of committing to the date and then we commit for the next meeting in 2 months. Because we know usually lenders like each other and they need a little bit to iron out the disagreements. And the problem was we had like, I don't know, 15 international lenders. Everybody was aligned except for one lender. And whatever we were doing, one lender was criticizing everything. It was not good enough. It was bad. And then was not supportive. And so we had agreement among like 14 lenders and one lender not. And the problem is we are talking. And next week we have a meeting with the regulator on site. Yeah. And you cannot go to the regulator, sorry, but we don't have agreement among the lenders. So what we did, we told, look, guys, it doesn't work over the telephone. It didn't work over the meeting in Zurich. So next week, one day before the meeting with the regulator, we meet on site in the capital of that country. And either we agree or we don't agree. If we don't agree, then the bank will be unplugged, go into liquidation, we lose everything. Yeah. And we came, and then there was another problem that some people were leaving the phone. Then we put it on the table that, look, they are not very cooperative. They slow down everything. We need our speed and pace. We need to agree on the settlement with this lender, because if we don't get rid of them, we cannot proceed. But the beauty of restructuring, usually you need to provide the fair treatment of all lenders. And I told, look, we need to get rid of them, but it will be exceptional. Whatever we offer this lender, we cannot offer everybody, because otherwise the project doesn't work. People accepted that. And it was really great spirit that everybody accepted. We go on, somebody gets something what we don't get. But one of the lenders wanted that the haircut is double of the size what party was ready to swallow. And it was really a picture, like we meet in that capital, in the meeting room, in the bank, and we announce there's a double haircut, and this lender simply stands up, so look, it was waste of my time and energy to fly here. You have misled me, I'm leaving the room. It's senseless, yeah. And then we just ask them, would you be capable to review this offer, to provide your final position, to come back maybe in 2-3 hours, talk to your management, let's see, maybe our positions are far away from each other, and somehow through this massaging and so we managed to bring people to the table, and we agreed on the date also. So next day we could go to the regulator. But it was a little bit like phone did not help. You need to force people to fly in. But even then, some people want to leave physically the room. Yeah.
All right, with that, I think we deserve to see the answer to the poll. See if people learned what you wanted them to learn. Any comments on people's responses?
I'll jump in. Tim and I and Oleg have a saying that the objective of restructuring is to achieve the least worst outcome. And so I guess avoiding damage for all parties means avoiding the least amount of damage which is possible under the circumstances for all parties. Tim and Oleg, what do you think?
Yeah, I would have to agree, Richard.
But we are now commenting on the skill, yes?
Yeah.
Yes, just basically, you've drilled this home the whole time. I think that it takes a lot of empathy and emotional awareness. And I have some questions coming in here, so I'd like to jump into the questions so we have plenty of time for those. This is a very practical question for Oleg. It says, I am running a restructuring team in a financial institution. I have a practical question for Oleg. I'm currently struggling with a deal in Africa whereby despite a signed term sheet, sorry, hard to see, a clear roadmap agreed between parties, legal docs drafted provided from our counterparty is constantly delaying communication and is showing very slow behavior. My gut feeling tells me they are buying time. Question, what is the borderline for you when you decide to stop negotiations as you believe the counterparty is buying time and proceed with alternatives? We communicate directly with the shareholder of the company and the CFO. Anyway, yes, that's his question. Oleg?
Yeah, I think it is, I mean, the beauty of restructuring, it's usually not black and white. There's a lot of gray area, many nuances. But I think what helps in that situation, most likely, as a colleague who is asking that has done, I think it's very important to understand why somebody tries to buy time.
Mhm.
Why? And if you understand that, then the question is, do the interests overlap sufficiently or not? If they overlap sufficiently, maybe it's better to find compromise and to agree on something in order to, because this is, of course, doesn't help if somebody tries to buy time. If they don't sufficiently overlap, it's important to acknowledge, to realize that, and to see, is there any way, like, I don't know, settlement or some bigger compromise to resolve the situation. Yeah, because if the interests are too much to the contrary, if you're in the fighting camps like opponents, it's very difficult. But what might help also to meet on the management level with this institution physically, and also to put all the cards on the table to discuss, look, guys, if we continue like that, we lose that, you lose that, let us see if we can generate value together. Yeah. So I would respond to that this way.
Perfect. Next question. What do you think are the best early indicators or risk flags of imminent credit issues with borrowers?
Well, I'll start, and then Tim and Oleg, please jump in. It depends, a bank versus a corporate, and then within a corporate, what sector they're in, and then secondly, a function of the market and macro environment. I think that typically what you're focused on is the present and foreseeable capacity of the borrower to honor their payment obligations, and therefore looking at the various elements of their business that generate the cash flow would be where you would be focusing. A second area that's useful for banks is to try to get plugged into the local interbank market to see how they're funding their overnight positions. Are they a desperate taker of cash? At what price? And then I think thirdly, if you begin to see activities by related parties and shareholders and directors, that might give you an indication that there's something amiss. Tim?
Yeah, I would have to agree. A lot of the problems are credit related, and so they're more in Richard and Oleg's jurisdiction. But in terms of legal issues, obviously there are the covenants in the event of default clauses in the loan. But as Richard just indicated, also the way in which your counterparty communicates to you, their explanations for problems. If what they're telling you doesn't make sense or it's contrary to fact, then there's a big question mark or red flag there. And whether or not they deal with legal issues in a way that indicates that they are going to deal with you up front. A lot of times borrowers in emerging markets will say, well, this is just the way we deal with things here, so don't pay attention to that. And that's not a sufficient explanation from a legal standpoint, but because if they are not abiding by the laws and regulations in their own jurisdiction, how can you expect them to honor their obligation to pay you back? So that would be some of the things I would think of from a legal standpoint.
I mean, I could add just to that first of all, maybe to demystify, there's no magic indicator which will tell you, hey, here's the problem. What is important, I think, going back to Richard, you need to understand the market. And if you see, for example, a bank reports much better asset quality than the peers, I don't think that they may be manipulating the numbers, but you need to understand the story. Yeah, because for example, it can be already an indicator that somebody is much better than others. You need to understand why. Another good indicator is if one bank pays much higher rate for the deposits for the money on the interbank market, because most likely there is not trust in the market to this institution. it's again, it doesn't mean necessarily bank is in trouble, but you need to understand the story. I think all indicators, they help us only, they are not answering, they are not help us to ask the right questions in due course. So, but this is, it's again, I think market environment context is extremely important here.
All right, thank you. That was comprehensive, very, very nice. Next question. When it seems so obvious that aligning lenders and restructuring the, when it seems so obvious that aligning lenders and restructuring the debt, why does the capital market often seem to not follow that strategy, but to go for quick wins? And it seems accepting less recovery and destabilizing the market.
I was working on a transaction recently where someone explained to me that if I had worked at X, which is a firm that they were at before, we would have finished this restructuring in one afternoon. We would have seen what the net asset value was and just basically go in and blow it up and take the money. The very first poll question talked about market stability, and I think that our view, say we, the three of us, certainly in our practice, is that there is a responsibility that we have to the stability of the market, to the 1,000 employees of which Oleg spoke. And so I think that rather than just killing the company and selling the assets and getting 30 cents on the dollar and being done by the weekend, there's the view that a consensual approach, which balances as best as possible the interests of all the stakeholders and allows the company to finish the process with a going concern status, is in the long term in the interest of the market as a whole. And so I think it really is just a difference of, do you believe in that longer term element? Now, that having been said, we all work for companies where there's a bottom line, and so there's as Tim said, there needs to be a cost benefit analysis. If you can't do that in a reasonable period of time with a reasonable expectation of a net return, then you pull the plug. Tim and Oleg.
I would just add to that then. Let's look back at what the INSOL principles themselves say. In principle number 1, it is critical to have creditor aggregation and to have homogeneity between the creditors so that everybody is playing from the same play sheet. If you have conflicts of interest amongst the creditors where they have mitigated against their risks differently than one another, then you're not going to get people around the table. The perfect example is a creditor who has security. Their interests are going to be different than unsecured creditors, because if they have sufficient collateral that they can enforce against immediately, why should they sit around at the table with the other lenders and try to do a deal just for the sake of keeping the borrower intact? The likelihood is if they've mitigated by collateral and they can easily enforce against it, then they will. Or have they put in place maybe a credit default swap or some form of credit insurance? These type of mechanisms, the credit insurance will require some form of default. And so they're happy if there's a default, and they're happy to be able to collect on their insurance. And so those are the types of things which are going to impede arriving at a consensual solution involving that creditor.
I could also add, sorry.
Go ahead, Oleg, go ahead.
I just wanted to add this. It's very, I mean, because it sounds so naive, so easy, but usually you have different interests, and I think the example from Tim with the credit default swaps, it's very good one, because you can have situation when 20 creditors want to rescue the company, but one creditor has insurance and needs default. Yeah. And is ready to jeopardize everything just to recover money. And I think it's very important to understand this, to have this knowledge, and maybe to find some solution which would serve for this party, for other. And this is because we have asymmetric information, we have different organizations, very important. So coming back to understanding the agenda, because usually there is some reason why people behave certain way, organizations. as is governance structure or some sensitivity, some experience in this market, lack of trust. And if you understood that, you can better handle that. But if you don't understand and people just reiterate this frustration critiques, usually it brings into nowhere. But
Yeah.
sorry.
Yeah. No. I was going to say that on one transaction that two of us worked on at the end and kind of the post-mortem conversation, I asked the CEO, what is the biggest lesson you learned for the last 9 months? And he said, choose your lenders wisely. And by that, he meant the type of institution, their experience in difficult situations, their corporate objectives, so that you would try to avoid situations where, for instance, if you take the example of the credit default swap, and Oleg learned of that and said to them, well, look, let's find a way that you don't derail the whole process. You need to be certain that the institution will engage in good faith in that conversation to balance their benefit, which is just to activate this, the trigger this, the payment under the swap, versus the benefit for the group as a whole of not having that precipitate a liquidation.
All right, with that final piece of advice, I think that was a good closer. Thank you everyone for joining. You can go out and buy Richard and Tim's book if you want to know more. It's out on Palgrave and all the normal sources online. Otherwise, follow us on LinkedIn, and we hope you join us for future webinars. Thanks, and see you around.
Thank you very much.
Thank you very much.
Richard, Tim,
Thank you.
Oleg. Bye.
Thank you, Oleg. Thank you, Kim.
Bye.